Hey everybody, Marty Missouri. Good morning, March 27, 2019. Going to spend, a minute or three and update you on the chart. It's been just a few days since we've done that. Folks who are new to the blog, we started looking at this chart back here just as the market was bouncing off of that amazing nearly 20% correction, not quite on a closing basis. And we began following the market up. I talked about technical indicators and support and resistance. And the market has pretty much gone along the lines of what the technical indicators suggested it should. In fact, I was pretty bullish coming in here relative to when we hit this point in the past. Since then, though, we've had some breakdown in a few of the indicators, and I'm not as bullish at the moment on a very near-term basis as I was back in here. This 2800 line right here is being tested even this morning, or we're getting real close to testing it. The market's off a bit. Was really strong, stiff resistance back in here when the market was trying to recover from the first leg of this correction. Right in here, we had really bad news on relationships with China. That is the explanation for what turned out to be the worst December since 1931. Since then, we've had relatively good rhetoric, off and on good news about Brexit, which is a big deal. The UK leaving the European Union, it's a big deal in terms of whether or not they leave with a viable trade agreement with the European Union, which, by the way, is the largest trading bloc on the planet, which can help you understand why it concerns me that the administration in the US is threatening to pivot away from China once a deal is done toward a potential trade war with Europe. The market, I can say this with a great deal of confidence, will not withstand months and months more of the uncertainty over trade. Where I turned very skeptical, if you read the blog post last week, I came into the week pretty optimistic. My data was telling me that things are looking pretty good. And last week should have turned out well until the president said he's leaving all tariffs intact as part of a deal with China. Market tanked, rallied on the Fed news, ended up that day down 140, had a nice rebound rally on Thursday in terms of the Dow, up 240, but then closed down 460 points on Friday. This week we're kind of going back and forth. The two top negotiators for the U.S. will be in China this weekend. But I can tell you, folks, with a great deal of certainty, if we don't do a deal that rolls back the tariffs that have been implemented during this trade war or skirmish or whatever you want to call it, I do not have a scenario that says that that's bullish for the market. In fact, a study that came out this week, and there's a link to it in a blog post I wrote, I believe it was yesterday morning, really quantifies the hit both to the U.S. consumer, to the U.S. economy, to supply chains, and so forth, that just the new tariffs have really levied onto the situation or onto general conditions. Overall, general conditions are still okay. We have an inverted yield curve. I wrote about that over the weekend. If you didn't get to see it, it's in this week's message. Yesterday, the Conference Board's Consumer Confidence Index, well, the headline was okay. When you look below the surface, there are some key internals that are really concerning. That, for example, expectations versus current situation is beginning to deteriorate in terms of how people feel about their situation going forward. There's some deterioration in what they see in on the jobs front and so forth. So this reflects the underneath waning that we're seeing in macro conditions. Again, we're not seeing, by our estimation, huge recession risks, but we are seeing a deterioration. I think a lot of it has to do with sentiment. Some of it, as the study that I just suggested, has to do with real hard data. And forgive me for being, once again, so singular in my concerns, but I do think the overwhelming headwind that is really permeating this data and creating the negative tone is the prospects for a protracted situation as it relates to trade. Now, the administration really wants this to work, really wants the economy to benefit from it, really wants the market to benefit from it. That's why last week and then again at the beginning of this week, I said, do not bemoan a sell-off because it tends to send a signal to the powers that be that what they're proposing isn't going to work for the market. And for political purposes, it really needs to work for the market. So we've got two things going for the market. We've got too much political risk to a poor trade deal, and we've got underlying conditions that are still okay. So if the trade deal goes off as it should, amid decent economic conditions, then we have a resumption of the bull market into new all-time high territories. Our job here, though, is to keep our finger on the pulse of general conditions. I think that we can dip a bit more and actually get a good trade deal and see conditions begin to rebound quite notably, especially when we factor in the fact that the central banks virtually the world over, with the exception of Hungary comes to mind, are being really, really accommodative, lowering interest rates, easing monetary policy everywhere they can. That's very bullish for the market when we're not in a recession situation, and that's where we are right now. We just need to get this trade stuff fixed. So anyway, I told you I'd show you the chart, and here I am rambling the whole time. So we still very much in an upward trend. I've got the higher highs, I've got higher lows. You know, this is still the definition of a bull market. Where I'm concerned is one of my favorite, very simple indicators, on balance volume. This is a bearish divergence. This says that while price has moved higher, conviction has moved lower. More distribution than accumulation. That's what we saw right here, only much more dramatically so at the top in September. You may recall, wrote an article back here warning that a downturn may be coming. Not about twice as much as what I was anticipating, but still conditions were okay. So this was not actionable on our part, and we're glad we didn't take action on it because, of course, we've come out of that quite nicely. Where we go from here depends on some very important decisions that need to be made relative to trade. Brexit is similar to the trade deal with China because the political risk of a no-deal Brexit and the economic and market fallout from that are extreme. So we should expect more delays in the process. There's some key votes that are happening this week. Ultimately a deal that both sides can agree to. So I'll keep you posted. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Have a great day. Bye-bye.